Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Global stocks two-day rally grinds to a halt as US trade rows roll on. Nvidia slumps in extended trade after Washington imposes new restrictions on exports to China. Make me an offer. President Trump says the ball is in China's court to make a deal over tariffs. The White House adds a probe into potential tariffs for critical minerals. Plus, ASML reports first quarter earnings shortly. We'll discuss AI demand and the outlook for the world's top chip machine company. Well, a very good morning. If you thought it was going to be a quiet Wednesday, an opportunity to put your feet up before the long bank holiday weekend, you were wrong. We've got a lot of news for you, including breaking news across the terminal, ASML earnings, the Dutch chip equipment maker, of course. Analysts were expecting a solid first quarter in terms of sales, partly on this strong Chinese demand. And what you're looking at are first quarter bookings coming in at 3.94 billion euros. The estimate was for 4.82 billion euros. So a miss there, in fact. We have an announcement from the CEO here on tariffs, because, of course, that really is the focus here, the outlook ahead, given Donald Trump's policy. And the CEO saying that tariff announcements have increased uncertainty. So echoing the message from plenty of CEOs across sectors. But, of course, chips very much in focus, very much in the firing line for tariffs, because, yes, there is an exception now, but we're waiting for the results of the probe into what the specific tariffs are going to be for that sector. And indeed, ASML has really borne the brunt of this broader market sell-off driven by tariffs and doubts over AI demand. And given ASML's position in the chips AI supply chain, it's very much at the mercy of how chip makers deciding on their spending. So you're looking at second quarter gross margin of 50% to 53%. The estimate was for 52.3%, pretty much in line there. But we'll get more for you on this with our specialist reporters later in the programme. Checking in on these broader markets, strap in, my friends, because the tariff whiplash is back. The relative calm that US futures seem to have been enjoying over recent days is really getting a reality check from these Nvidia warnings that Donald Trump's curbs on its China AI chips are going to cost $5.5 billion. So futures on both sides of the Atlantic pointing lower this morning. Nvidia having slumped more than 6% in after-hours trading, and that news already weighing on Asian stocks this morning. Even though we've had this better-than-expected China data, it could not turn this tide, though, of course, that really does just document the calm before the tariff storm. Now, as I mentioned, Donald Trump's also launched a probe into the need for levies on critical minerals. So let's flip the board to the cross-asset picture, because we've seen gold hitting a new record on safe haven demand. Euro-dollar currently at a 113 handle, and that's on the flip side, of course, of another down day for the dollar. We keep an eye on that. And on the flip side, again, we keep an eye on cable. 132 is where we trade ahead of the UK CPI data at 7 a.m. London time, and the 10-year yield currently at 4.3%. But, of course, we wait for the latest commentary from the chair of the Federal Reserve, Jay Powell, later on today. But let's dig into the latest on Nvidia. Shares falling sharply in extended trading after the company revealed it faces new US restrictions on chip exports to China. The Trump administration barring the sale of a chip explicitly designed to comply with previous US curbs. And we can talk to the opening trade anchor, Kriti Gupta, for more. Kriti, good to have you. Just please do explain what on earth is going on here. What is this exact restriction on Nvidia? What does it mean for the company?
Well, having a little bit of deja vu here, because in the first Trump administration, we had this exact problem where Donald Trump was concerned, and though Joe Biden's administration also, I should admit, both administrations have been concerned about how much American technology, especially AI technology that's embedded in not just things like EVs or even things like smartphones and washing machines and laptops, but also in things like military intelligence, are getting ultimately exported out to China. So there were chip restrictions primarily that kicked off under Donald Trump, but were kind of elaborated and exaggerated and grew under Joe Biden. Nvidia had found the workaround with this H20 chip, saying that we can still serve the China market if you kind of strip away some of the key pieces of technology. So these chips are meant for things like more consumer electronics, not necessarily military intelligence. So they thought they had gotten around that while still being able to serve a market that is crucial to their underlying business model. It's also important to keep in mind that there have been reports that in exchange for kind of laying off on some of these chip restrictions, perhaps Donald Trump would be more amenable to doing that if Nvidia would increase their investment domestically in the United States, specifically in the South, which is something we've seen the likes of Intel do, for example. That doesn't seem to be the case, because even after literally 24 hours after this massive investment that Nvidia had announced in the United States, these restrictions are coming back into play. There seems to be a little bit of a delay there. But now the big question, as Nvidia had announced themselves, by the way, this announcement hasn't come from the Trump administration. As you point out, $5.5 billion of a hit on inventory, not even production, but inventory that was already going to get shipped out. And they're not alone. A lot of these technology companies are having this issue.
Yeah, it's hard to see how they're going to get around this when, as you say, it was already a loophole that they were using. They've already put the investment in. How do they get what they need out of the Trump administration? On the flip side, though, we need to think about how it changes the outlook for China tech.
Well, for China tech, but then also for American tech and European tech that has that exposure. So I'll give you another example here. I mentioned Intel and this kind of push to do domestic manufacturing in the United States. Micron is another example, because the counter response from China in the previous iterations of this conversation was that we will then put restrictions on the likes of Micron's chip exports into China. So what Micron ended up having to do, and you've seen other international companies do this as well, is reduce their exposure to the Chinese market. So Micron, for example, at one point got 10% of their revenue from China, and that has now been scaled down. It's still being hit. It still is a crucial market for them, given the growth that you're seeing in China, but you are starting to see that get hit. This morning, of course, Chinese tech is also taking a major hit because Nvidia is a key input into a lot of this. At the end of the day, the AI demand, there's really only one company that serves it to that extent, and that is Nvidia. So this is a supply chain shock that goes in two different directions.
OK, opening trade anchor Tricia Gupta, we thank you for that. But let's stay on Nvidia and speak to Lian Ting Tu, Bloomberg's managing editor for stocks in Asia, and look at the market reaction here. Lian Ting, what has been the reaction?
Yeah, I think it is spot on. As the previous reporter was talking about, there was a big hit on China's tech names, and Chinese tech companies are actually underperforming the broader market. And the broader concern is that the China's tech sector will be further choked from their accessibility to the hardware, most advanced hardware tech from the U.S. But if you look under the hood, today's sell-off also came after 6 straight days of gains. And other than China's internet names, if you look at China's chip makers, they're actually holding up relatively well on bets that, they may have to be more innovative and more self-reliant, and more demand from Chinese companies will have to go to the domestic chip makers. So that is sort of like a bright spot right now.
OK. I mean, hitting Nvidia with curbs is surely like hitting a country with curbs at this point. But this has weighed, as you say, on the market, despite that good news when it came to the China data. Would you say that that's irrelevant given what's to come in terms of tariffs? Or how much scope is there for the government in Beijing to turn this around? Will they inject more stimulus to get to that 5% growth target?
Yeah, I think the decision that China has made to go for the tit-for-tat trade war with the U.S. also means that they are determined to pump up more liquidity and more fiscal stimulus to boost the economy. So yes, the data that we saw that was resilient came before the trade war, and we are expecting some kind of further boosts from China's policymakers. It could be PBOC rate cuts or triple R cuts, because in some corners of China's economy, we're already seeing the impact from the escalating trade war with the U.S. As our colleagues have written in this Canton Fair that is going on right now, which is the world's biggest trade fair, we saw a ship company manager said that 70% of his orders to the U.S. got cancelled or delayed. And there is also news about how some factories will have to lay off some workers because of cancelled orders orders or just orders evaporating overnight on the tariffs. So overall, I think China's economy is definitely not looking good right now. But the stock market is not 100% representative of the economy, we have to remember, because the members in the MSCI China index actually only has about 3% revenue exposure to the US. So as long as China doesn't go into a recession, the fundamental hit to their earnings would be limited.
OK, Liang Ting Tu, Bloomberg's managing editor for stocks in Asia, we thank you. And now let's look at those US-China trade negotiations. How are they progressing? President Donald Trump has called on China to reach out to him in order to kick off those trade talks. The move aimed at resolving the escalating tariff war between the two largest economies.
I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country except they are much larger. And China wants what we have, what every country wants, what we have, the American consumer. Or to put it another way, they need our money.
Joining me now for analysis is Derek Wallbank, Bloomberg's senior editor for US economy and government. Derek, I've read some commentators this morning calling these Nvidia restrictions, well, saying that they reveal new depths of abusive undercurrents in the US-China relationship. And yet you've got the president asking China to call him to make a tariff offer. What's the latest?
That's right. Ball's in their court, right? Theirs to return or put into the net, or however you want to use that analogy going forward. The ball from Trump saying that it is China's move to make, right? Now, look, there are any number of things that you can pick apart with this statement, but I'm going to start with the idea of face, and that is the idea that China needs to find a way into these negotiations without looking like it's capitulating simply by joining them. Trump is not right now publicly giving them the way to do that. And everything that we hear from both sides is that while they may be talking at small levels about here and there and all sorts of things, nothing really is happening at a high level. Jameson Greer, the U.S. Trade Representative, said we're not there yet. We're hearing the same thing from the Chinese side. So that's kind of where we are right now. Who's supposed to pick up the phone and call who? That is a divergence with a lot of different off-ramps, right? Potentially anybody could pick up a phone. But it does signal the fact that nothing's necessarily imminent right now. Nothing's immediately on the cards. I think everyone is waiting for that chance when Trump and Xi talk, maybe when they meet. But something like that does not look like it's immediately imminent at this point. I would say, if you look across the wide range of U.S. tariffs, you do find that China is the biggest target there, not just because it's the world's second largest economy, but in terms of overall rates, as well as in terms of where some of these particular sectoral things seem to be targeted. And we are seeing Trump make some moves forward, particularly with critical minerals and things like that, where he feels like the U.S. is vulnerable potentially to Chinese pressure, trying to increase American capacity to be able to take China's pain points and reduce them.
Well, yeah, you mentioned critical minerals. We've had Trump overnight launching this investigation into the need for tariffs on critical minerals. What's the scope of that probe, Derek? When could we actually see those tariffs coming into force?
Well, I think these probes are really interesting because you've seen, I think, a lot of market reaction to Trump moving very swiftly. But this level of probe is actually something that's a lot more deliberative. Technically, Trump's advisors have around and about 270 days to come back to him with something. They don't have to take all of that time, of course. It could be much faster. But they theoretically have a good part of the rest of the year yet to go before they have to say exactly where those things go. So this could be quite a long, drawn-out and deliberative process from here on critical minerals. But it goes to the sort of point about Trump wanting to kind of carrot and stick U.S. production. On the one hand, there may be incentives for people to try and build some of this capacity of either mining or refining or whatever that might be. But on the other hand, there's this stick, the idea that you will not be able to get this stuff in cheaply forever. And while there may be 270 days for a recommendation to come forth, there are nearly 4 full years left on Donald Trump's term of office. So if you do that math, the math suggests that Trump will be in a position to make a decision that could be lasting for 3 years or so or more if someone ideologically inclined follows him in the White House. So there really is a sort of stick being brandished, even if it's not going to be used to hit anything just yet.
Okay. Derek Wallbank, Bloomberg senior editor for US economy and government, we thank you. With a slew of news already breaking this morning, but we've got plenty more ahead on the docket when it comes to the economics. At 7 a.m. London time, top of the hour, we get the latest UK inflation data, expected to have eased at the headline core and services levels. But remember that it is expected to rise again by September to 3.8%. That's the number our economists have penciled in. Then more eco data, but next out of the US at 1:30 p.m. London time, it's retail sales. They're expected to have risen from 0.2% in February to 1.4% in March, as consumers really have got their buying in before tariffs kick off, so likely to be a temporary bounce. And then maybe we'll get some analysis of that from the Fed chair. At 6:30 p.m. London time, Jay Powell is speaking. He's at the Economic Club of Chicago just before the holiday market closure. Is he going to echo Christopher Waller's confidence that the Fed can perhaps look through the inflationary impact of tariffs and really focus on growth? It'd be a lot more dovish than when Powell last spoke on April the 4th. But we've got traders now pricing in 84 basis points of cuts from the Fed. So let's see how that changes after his comments later on. Coming up on the programme, more tariffs. We're going to talk about how China is responding to the policy. China's president calling for Southeast Asian nations to help protect global trade in the face of Donald Trump's trade war. We'll bring you all the latest as Xi Jinping visits Malaysia. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to Asia, where the Chinese President Xi Jinping is calling on Malaysia to work with Beijing to protect supply chain stability as he visits the country on the second leg of his Southeast Asia tour. The trip comes as President Trump urges China to reach out to him to calm the trade war. But a former top Chinese economic official has told Bloomberg exclusively that Beijing is unlikely to accept Washington's conditions lying down.
We fully respect the U.S. We fully follow the instruction by President Xi Jinping. We do everything maintain the healthy, stable, and sustainable relation with the U.S. But this time, again, we must take action, retaliate, because we don't want the whole world return to the jungle of jungle law.
Zhu Wangyao speaking there. Let's go straight to Malaysia. Avril Hong is on the road, as is President Xi. Avril, what's at stake here?
Yeah, there is so much at stake, Lizzie. It's almost difficult to overstate the importance of this visit, coming at a time when China is trying to shore up economic growth domestically. We hear about this action plan today, and then also shore up supply chains. Don't forget, when it comes to the Southeast Asian region, some of them were among the highest when it comes to the tariff rates from Trump. So there is certainly a lot at stake here. And the job, I think, for some in the minds for Chinese President Xi Jinping is to convince Southeast Asian countries not to eke out deals with Washington that could potentially come at the expense of Beijing. And also, at the same time, promote China as a stable partner, more stable partner than the likes of the U.S. And then for the Malaysian side, keep in mind that China has been, for well over a decade, its largest trading partner. Total value of trade between the two sides last year exceeding $100 billion. But this is all coming at a time when Malaysia is trying to negotiate with the U.S. on the tariff front. So it's a very fine balancing act. It has to do this while being friendly with Beijing. Now, just to give you an idea of the sectors that could come into play in discussions between the leaders of Malaysia as well as China, remember, for Malaysia, it is a player in the rare earths industry, even though it's still in sort of the nascent stages. It does house, outside of China, the largest processing plant for rare earths in the world. And on top of that, it's also a really strong player when it comes to data centers as well as lower-end semiconductors. So keep that in mind as China really tries to build out its tech dominance, some of the rivals and allies it can lean on. Now, just to give you some color as well, where we're standing outside this complex where the Chinese and Malaysian leaders are set to meet later today. We're expecting exchanges of MOUs, remarks from the two leaders as well. They've really rolled out the red carpet for the Chinese president. All the way in, we've seen these billboards welcoming Xi Jinping. And along with that, we've seen a hive of activity going into the complex today in terms of flowers, performers, durians even being delivered. So a lot at stake and warmly welcoming here the Chinese president.
Okay, Bloomberg's Avril Hong in Malaysia. Excellent reporting. We thank you as we follow that first trip overseas of President Xi this year. Interesting to note, the Wall Street Journal saying that Donald Trump's plan is to use all these trade talks with countries around the world to isolate China. And in fact, that idea, that strategy, it reports, was the brainchild of the Treasury Secretary Scott Bessent. So we keep an eye on that. But let's get back to how the markets are reacting to all of this. The US government bonds are gaining after a Treasury official suggested a rule change to lower trading costs for banks. Bloomberg's Valerie Teitel joins me now on set. And Val, dare I say it, but this looks like calm in the Treasury market with a potential rule change in the pipeline.
Yeah, calm in the Treasury market. We've had a decent rally across the curve to start the week. The 5-year yield outperformed yesterday on this chatter around loosening of bank capital rules. To start the week, the 5-year yield is now down over 20 basis points since Monday's trade. A lot of this with that speculation that perhaps the rout in Treasuries last week is pushing this deregulation when it comes to bank capital rules on Treasuries to the top of the agenda for the Treasury. We actually had some words from the deputy Treasury Secretary talking about loosening these bank capital rules. This all comes down to scrutiny of the SLR, which is the supplementary leverage ratio. Essentially, they'll be aiming to reduce the risk weighting of lenders holding Treasuries. It will give those lenders, those banks, more capacity to hold Treasuries on their balance sheet, Lizzie. They won't necessarily be penalized for holding Treasuries like they have been in the past. And this perhaps can help the market really digest the supply of Treasuries that we've been seeing. A lot of chatter recently about the recent imbalance between this enormous supply of Treasuries hitting the market and perhaps less demand behind it. I've got a chart here behind me of the CBO projections of the size of the Treasury market expected to nearly double by 2035. So maybe this SLR reform, this easing of bank capital rules, will help the market digest the supply of Treasuries that is expected to pick up in coming years. Finally, Lizzie, I got to mark what's going on in the dollar. The Bloomberg Dollar Index finally snapped its losing streak, which took nearly 3.5% off its value in the last 7 sessions. We finally have snapped that losing streak, which lasted for 5 sessions in a row.
Yeah, but the Bloomberg Dollar Spot Index currently weaker, 0.4%. Val, you're looking at euro dollar up 0.6%, and the pound up 0.2%. The Swiss franc up 0.9%. So a new haven, perhaps, looking at us out of the franc. But Val, we thank you. Coming up on the programme, we're going to get back to those breaking earnings from ASML, reporting a big miss as the chip machine maker warns of uncertainty from President Trump's tariffs. We're going to dive into the company's first quarter earnings later in the programme, so do stay with us. This is Bloomberg. Now to the latest in geopolitics. Bloomberg has learned that the US appears to be softening demands for Ukraine to pay back military aid via a proposed minerals deal. Sources say that the Trump administration has lowered its estimate for the assistance the US provided to Kyiv from $300 to $100 billion. Interfax reports both sides are holding talks this week, with the Ukrainian president calling the discussions positive. Stay with us. We are going to look into those ASML earnings next. This is Bloomberg. A very good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Global stocks two-day rally grinds to a halt as US trade rows roll on. Nvidia shares slump after it warns new restrictions on exports to China will set it back $5.5 billion. Make me an offer. President Trump says the ball is in China's court to make a deal over tariffs. The White House adds a probe into potential levies for critical minerals as well. Plus, a miss for ASML. The chip machine maker's first quarter bookings fall short by nearly €1 billion. Its CEO says that President Trump's tariff announcements have increased uncertainty. Well, a very good morning. And if you thought that you could breeze into the long holiday weekend, you were wrong. We've got a slew of news to bring you this morning. That relative calm in US futures that the market really has been enjoying in recent days is getting a real reality check this morning from Nvidia itself, warning that Donald Trump's curbs on its China AI chips are going to cost it $5.5 billion. So you're looking at futures on both sides of the Atlantic pointing lower. Nvidia slumping more than 6% in after-hours trading. We'll get to more on that in just a moment. But the news already weighing on Asian stocks. Even the better-than-expected Chinese data couldn't turn this tide, though, of course, that really documents the calm before the tariffs storm, plus a miss on ASML earnings to factor in. But let's flip over to the cross-asset picture, because President Trump has also announced a probe into the need for levies on critical minerals. You've got gold hitting a fresh record on this safe haven demand. Euro-dollar at a 113 handle, up 0.6% as we see another down day for the dollar. Cable as well has been in focus because we've got the UK inflation data at the top of the hour, but you've got crude there at $60 a barrel, up 0.9%, and Bitcoin at $83,000, up 0.9%. But let's get more on that miss from the first quarter for the Dutch chip equipment maker ASML. It reported bookings of just under €4 billion, nearly $1 billion less than estimates. Bloomberg's Charlotte Hughes-Morgan joins me now on set for analysis. And Charlotte, this is a surprise, isn't it? What led to this miss?
Well, basically, yes, as you say, Lizzie, obviously ASML is this kind of crucial part of the AI supply chain. It's really seen as kind of a bellwether for the semiconductor industry. And as you said, you know, this booking metrics is a really important metrics. It's an indication of future customer demand. And, you know, it came in, I think it's an 18% miss from the analyst estimates. And basically, investors are going to be kind of scouring these numbers and thinking, OK, you know, what is behind this? And I think there are two things, basically. I mean, there's concerns about whether AI demand can keep up the momentum we've seen. There are some doubts about kind of key customers like Intel and Samsung, their ability to spend on capex, which obviously then impacts demand for ASML's machines. And then, of course, you've got the uncertainty around tariffs. It's worth noting that ASML did keep its 2025 outlook unchanged, but the CEO said, you know, that's subject to some of the uncertainties we're seeing in the macro environment at the moment.
Well, so what specifically did they say on tariffs? Because even though we didn't expect the previous performance to be like this, we always thought that the focus was going to be on the outlook because of tariffs. What is it that they're saying comes now? So,
I mean, they're essentially echoing what we're hearing from a lot of business leaders. The CEO is saying, look, you know, there is a new uncertainty in the market and in our sector because of these kind of trade tensions, because of these tariffs. And actually, the CFO in the video transcript they released alongside results kind of gave a series of scenarios of what kind of might play out. But to be honest, it seems to be that they have the same visibility we do. And at the moment, we don't know when semiconductor sector tariffs will be announced, and we don't know what the tariff rate will be. So there is this kind of huge uncertainty hanging over the semiconductor sector as a whole at the moment. And the kind of leaders of this pivotal company in the semiconductor supply chain are essentially saying, you know, we don't know what's going to happen. We need to kind of factor this unpredictability into our kind of numbers for the future.
And of course, investors also very much on edge about this AI boom, you know, that's driven so much spending previously, the likes of Microsoft and Google pumping money into it. What are they saying lies ahead for that?
Well, ASML itself is saying, you know, demand remains strong. They are saying in the release, they said conversations with customers suggest 2025 and 26 will be a growth year. Investors and analysts are not so sure. I mean, we've seen kind of huge demand for AI. recently, but there have been some kind of cracks starting to appear, some doubts about, as I said, about spending capacity at key customers. And also, we had Microsoft walk away from data center projects recently, and some analysts have been flagging, okay, maybe this really strong demand we've seen, and ASML has been doubling down on that message about, artificial intelligence is really going to drive industry, but there are some indications that there could be softness on the horizon, so the market will definitely be kind of watching that closely.
Okay, Charlotte Hughes-Morgan, we thank you, and of course we are going to be watching ASML at the open, but until then, terminal users can follow Bloomberg's commentary and analysis on these ASML results live at TLIV Go on your terminal. Now, let's get to some other earnings this morning. United Airlines has taken the unusual step of offering two possible earnings scenarios. The US carrier says that its 2025 outlook remains achievable, but it also warns that a recession could nearly halve its profit forecast. If the current environment remains stable, United says, it expects that an adjusted profit of up to $13.50 a share. But in the event of a US recession, full-year earnings would drop to as little as $7 a share. So it just shows what this uncertainty at the moment is doing to this earnings season. Do not miss our conversation with Scott Kirby, the United Airlines CEO, on these earnings, as well as his outlook for the rest of the year and how they're navigating the potential trade war. That conversation's coming at 1 p.m. London time. Now, to some other earnings out of the US. Bank of America and Citigroup reporting record trading revenue as Wall Street banks rounded out an earnings season that also has been spiked with trade war uncertainty. The Citigroup CEO, Jane Fraser, addressed global volatility on a call with analysts.
I am not going to try to predict the unpredictable. While our corporate and consumer clients are resilient and in good financial health, the world is in a wait-and-see mode and is facing a more negative macro outlook than anyone had anticipated at the beginning of the year. And we know that prolonged uncertainty generally hurts confidence.
Well, Charlie Wells is here to bring us up to speed on these results. Charlie, just take us through the key takeaways from Citi and Bank of America.
Yeah, so their traders really made lemonade out of lemons, which was that volatility, right? So setting records across the board there, which is positive for them at a time of, as we've been talking about, record uncertainty, but also some kind of interesting results when you dig in. So when you look at Citi, for instance, their wealth unit hit a record, and that is really important for this bank as Jane Fraser tries to update it, tries to go through this huge transformation, and wealth is important in a time of uncertainty because you get those more predictable fees. Now, Bank of America striking here too. Their traders performed incredibly well, but you also get a read through on the consumer here, and the consumer is looking, as their CFO said, resilient. Net interest income beat. They actually set aside less in loan loss provisions than analysts had expected. And you also saw their loan balances beat expectations as well to $1.1 trillion. Loan growth has been so in focus right now in this lower rate environment. And that seems to indicate the consumer, at least right now, is still pretty healthy.
OK, I like it, Charlie, how you come on set and hit me with the optimism first, because so far this earnings season we've had this dichotomy, haven't we, between good news so far and then caution looking ahead. Is that what we heard from Citi and BOA?
Lizzie, that's what we heard, not just from Citi, not just from BOA, but from all of the big six banks in the U.S., where they really tried to kind of say, look, we know it's uncertain times, but if this trade war gets resolved quickly, that's all right. So you heard, Jamie Dimon talking about stormy seas, but you also heard Ted Pick of Morgan Stanley saying, the deal flow is on pause, not delete. And you even heard yesterday Brian Moynihan of Bank of America saying that their economists do not see a recession in 2025. Of course, so again, addressing volatility, addressing uncertainty, but, indicating that they are well positioned to handle what comes next.
OK, really interesting. Now, meanwhile, here in Europe, we've got bank earnings kicking off later this month. Is their outlook going to be similar to US peers?
Lizzie, I think the sense so far is that it will probably be less unified because you do have this geographic divergence. What we have known about trade negotiations so far is a potential difference in levies for EU versus UK banks. So that could, change the outlook for banks there. We've got a world where tariffs are inflationary in the U.S. but deflationary in Europe. That changes a potential rate picture. That changes, how profitable lending is for these banks. And then just the uncertainty kind of in the air could, mess with some of the positive factors that have really been kind of boosting banks in Europe. So cross-border M&A in uncertain times, that kind of goes on the back burner. You've got trading that's been performing really well at a number of these banks. Can they compete with their U.S. peers? These are, really going to be in focus as these banks start to report in a few days.
Okay. Bloomberg's Charlie Wells, we thank you. Wrapping up U.S. bank earnings season for us. And if we just remind ourselves of what we've already heard today, in terms of earnings, but on the ASML front, a big miss, and that seems to be reading through to Nasdaq futures, on top, of course, of the news from Nvidia about the warning of Trump curbing AI chips from China. That's going to cost them $5.5 billion, they say, and Nasdaq futures now down 2.25% as we head towards the Wall Street Open. But next, we're going to get to how the Europeans are dealing with the tariff threat. They expect US tariffs to stay as trade talks make little progress. We're going to discuss the outlook with Kallum Pickering, chief economist over at Peel Hunt, next. So stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the European Union and the US have made little progress bridging their trade differences this week. The Trump administration indicating that the bulk of its tariffs imposed on the bloc will not be removed. Let's get more with Bloomberg's Oliver Crook, who's been tracking these negotiations. Ollie, what's been the readout between this meeting of US and EU officials?
Yeah, Lizzie, listen, this is really the week in which the Europeans are throwing kind of all their emissaries at the Trump administration, trying to break through on a deal, trying to get information from the Trump administration in terms of what they actually want. We had Maro Sefcovic in D.C. on Monday. Yesterday, Carlos Cuerpo, the Spanish Trade and Economy Minister, speaking with Scott Bessent. And tomorrow it's going to be Giorgia Meloni, who heads to D.C. to meet with Donald Trump directly. What we got was more detail out of the meeting that was held on Monday by Sefcovic, Jameson Greer, and Howard Lutnick about European trade, any possible deal there. And the reality of the situation is, with the more detail that we got out of that meeting, there is very little detail that the Europeans got from the U.S. side in terms of what they want, on those non-tariff barriers. This is something we're going to keep coming back to, the sort of ambiguous non-tariff barriers that the U.S. wants to dissolve, so-called, on the European limitations to getting those goods into Europe, according to the Trump administration. But Lizzie, I think what is even more interesting now is the question is not necessarily the contents of a deal, but what is the goal of the deal? Are the Europeans now negotiating to basically dissolve those 10% reciprocal tariffs that exist, so-called, by the United States, or to preserve them, i.e. to not make them go up to 20% again after the 90-day window? That is still not clear. So we don't know, what the sort of different inputs would be to get a deal, and we don't actually know what the deal would be for, and that is a difficult position for negotiators here in Europe to be in trying to deal with the Trump administration, to say nothing of the fact that you may get a whole litany of new tariffs on pharmaceuticals, critical minerals, and semiconductors by the time, even before you get the negotiations done on the reciprocal and all the others.
I mean, dare I ask you, Ollie, what is the room for manoeuvre here? What are the next steps?
Yeah, so listen, we had this sort of readout from the meeting with the Spanish trade minister yesterday with Scott Bessent. Not a whole lot to see there. And of course, there's a sort of political backdrop there. Scott Bessent really wants to try to get American allies aligned on his vision of trade versus China, to get them sort of collective on the same page. And the Spanish, of course, are pushing in the other direction, saying that they need to actually open up more trade, more diplomacy with China. I think what will be very interesting is to see what comes out of the meeting tomorrow with Giorgia Meloni and President Donald Trump. Of course, politically, Meloni and Trump are probably the most aligned in terms of the mainstream big sort of leaders in Europe, Meloni and Donald Trump. There's been a lot of sort of talk between the two. J.D. Vance will then be coming to Italy on Friday to have more discussions. But really, the reality, I think, Lizzie, is not really the politicians that are going to make a great breakthrough with the Trump administration on trade. It probably is going to be the markets. If you want an indication of how likely a deal is or how likely progress is, look at the U.S. 30-year yield, the 10-year yield. Look at Eurodollar. I mean, as we speak, Eurodollar is now at a session high at about 113.55. These are the kinds of pressures that put the Trump administration, as we learned last week, in a mood to have some sort of discussions and potentially relent on some of those trade issues.
OK, Bloomberg's Oliver Crook with the top lines out of all of those trade talks happening across the Atlantic. We thank you. And of course, Bloomberg Economics has been predicting that US President Donald Trump's 90-day pause in reciprocal tariffs, so-called reciprocal tariffs, will not significantly impact the UK economy. It estimates a 0.5% hit to UK GDP from the current trade levies. So let's get more analysis now from Kallum Pickering, Chief Economist over at Peel Hunt. I just want to start, Kallum, actually, with what Ollie was saying there about the EU negotiations. Does it seem to you that the tariffs on the EU aren't negotiable and actually this is where Trump sees himself getting his revenue?
It's a good question. It's very difficult given the criteria that the US has put forward or the problems that it states it has with the way that its trading partners are behaving, that actually the EU would be able to step down on significant things. You read the Navarro piece in the FT, he claims, for instance, that VAT is a non-tariff, non-tax barrier to trade. This is a little bit odd. Right? VAT is ubiquitous. It's everywhere. In the US, you have state sales tax. Is the EU really going to change its VAT to get a trade deal with the US? I don't think it is. So either the EU has to concede on something big or the US has to step back. And also keep in mind, as the damage plays out for the US, Trump loses his leverage in these negotiations, and as the coalition of willing countries all say, why don't we just lower our trade barriers? It's probably better for the EU to save face and say, well, look, America, you can do whatever you want. We're actually going to lower trade barriers elsewhere. I think that's much better for policymaker self-esteem, actually.
And on that point about Trump losing his leverage, are you surprised by the market reaction to the Nvidia news this morning when we've just seen in the past 2 weeks that Donald Trump can slap tariffs and curbs on and remove them just as easily?
Well, the US has been the exceptional market and exceptional economy for our lifetimes and basically for most of the 20th century.
You say that in the past tense.
But I say that in the past tense because what does that exceptionalism mean? It means two things. First, it's an unusual blend of low risk and strong, predictable growth, and policymakers which have consistently made or avoided making the mistakes which are just normal around the world. It's not strange that somewhere a country has elected a president that has a strange approach to trade and wants to pursue internationalism. The surprise is that America has done it, and it's the conduct that's the surprise, and that's what's shaking markets. And I think that deep down markets are holding out that in the end, this is just some kind of grand, if slightly haphazard strategy to ultimately pursue what would be a sensible goal, which is lower trade tariffs and lower trade barriers. And I'm not sure that's the direction that we're heading, which is why we're reacting so positively to elements of good news. It leaves us with this initial assumption still alive.
Well, because I wanted to ask you, you've got a fabulous podcast, I must say, and I was just listening to it. You pointed out that the Ukraine war wasn't as bad as economists said for the economy. COVID wasn't as bad as economists said for the economy, nor was Brexit. So are economists just kind of getting in a twist about how bad Trump's trade war is going to be, and actually maybe he's onto something?
Well, for the US economy, this is bad. I mean, the US is probably the most naturally endowed economy in the world. Right? It has two coasts. It has rich soil. It has lots of commodities. It has a large population that's talented, well-educated. No other economy compares. Still, it benefits from globalization and international trade. And its biggest companies benefit the most. When we talk about the Mag 7, we're talking about the most internationally optimized companies in the world. At every single point of their production, they're placing production in the most cost and quality effective place. So onshoring actually hurts that. It's a less optimized economy. It's a less optimized company. But for the rest of the world, I think this is, as long as you don't reciprocate with tariffs, it's not an inflationary shock. The uncertainty effect is severe, but there will be lots of trade diversion. The US is a big market, but in the case of the UK, it's a direct exposure of around 2% of GDP. The UK can live with that. And so what you'll probably find is, after an initial period where the recession risk in the US is real, I don't think we need to worry much about a recession in Europe just yet. We go through this very uncertain period. But then actually global capital says we still need a home. Maybe we don't go in the US, maybe we go somewhere else, and actually these other places then start to be net beneficiaries.
Yeah, well, you mentioned the UK. I've got to ask you about this inflation data that we get at the top of the hour. Is it going to move the needle for the Bank of England?
No, and it shouldn't. It would have to be a very big surprise. I think the policy arithmetic has become much easier for the Bank of England. We have a very obvious growth risk. We have a very obvious confidence risk. Energy prices have come down, and the labour market is loosening. The Bank of England was already signalling to markets that it would want to cut more this year, take monetary policy to something like neutral. I think everything we've seen over the past 2 weeks strengthens that. So a cut in May, 3 cuts this year, I think we'll be at 3.75 by the end of the year.
All right. We'll see how the market bets hold up after 7 a.m. Kallum Pickering, Chief Economist at Peel Hunt. Lovely to have you. As always. Looking at futures currently pointing lower on both sides of the Atlantic still. We have Euro Stoxx 50 futures down 1.7%, but stateside S&P E-minis down 1.5% and Nasdaq futures down 2.3% as markets keep on digesting this news on Nvidia and ASML. Shares for ASML falling 5% on TradeGate versus the Amsterdam close. So let's see how they open. But we've got plenty more coming up, so stay with us. This is Bloomberg. Welcome back to our last few minutes of Bloomberg Daybreak Europe. Let me bring you a few charts just to set up your day. Look at where we are heading on Nasdaq futures. A reality check coming for US equities after a few days of relative calm. And this off the back of not just the ASML miss, but also Nvidia saying that these latest curbs on its AI chips to China could wipe off $5.5 billion from Nvidia. And Nvidia shares down on TradeGate, ASML shares down on TradeGate as well. We look ahead to Nvidia too. Flip the board, and before the open, of course, later on today we've got US retail sales coming as well. We've seen a pretty stable move since the pandemic, a bit of a recovery, but we're about to get, it looks like, a big bounce as consumers stock up on cars ahead of tariffs coming in. So are you looking for somewhere to hide out? Flip the board. Finally, if you look at where the Swiss franc has been, compare it to gold being in the blue line, looks like maybe you've got a new haven here. We've been discussing it all week. Investors' concerns about the dollar. Here you can see it. But do stay with us on Bloomberg TV. We've got a great conversation coming for you with Scott Kirby, the United Airlines CEO, on first quarter earnings, and the opening trade is coming up next. Looks like it's going to be an exciting one. Stay with us. This is Bloomberg.